If you're investing on a tight budget and it feels like nothing is working, like you're doing all the right things and still somehow falling behind, listen closely. It's probably not because you started with too little. It's because when your budget is small, you have zero room for invisible mistakes. A big portfolio can survive a few dumb trades, a few bad weeks of emotional decisions, a few unnecessary fees, a little hype chasing, a little sloppy asset allocation. A small portfolio can't. A small account is like a boat with a low water line. The same tiny leak that barely matters to someone else can sink you. And here's the part most people don't want to hear because it sounds too simple. Your strategy may not be failing because you need more money. It may be failing because you built it on the wrong foundation, one that feels exciting in a noisy market, but collapses the moment real life shows up. Today, I'm going to give you 5 reasons your low-budget investment strategy isn't working. And I'm going to tie every reason to something Benjamin Graham would recognize instantly: the difference between investment and speculation, the discipline of the defensive investor, the role of bonds and cash, the power of rebalancing, the obsession with margin of safety, and the psychological trick called Mr. Market, who shows up every day to tempt you into doing something you'll regret. By the end, you'll have a simple way to audit your own plan, something you can follow even if you're starting with $50 a week, even if you're starting late, even if the market feels like it's on caffeine and adrenaline. Now, quick note, this is education, not personal financial advice, but it is practical counsel, the kind of counsel Graham wrote for regular people who needed something sturdier than Wall Street stories. Let me start with a scene that might feel uncomfortably familiar. It's Friday night. You're tired. Work was a grind. You open your phone and you see the market doing what the market always does, screaming in headlines. AI is the future. This stock is up 40% this month. Recession fears. The Fed might cut rates. Inflation is sticky. Crypto is back. Meme stocks are trending again. And somewhere in all that noise is you with a small automatic transfer schedule. Maybe it's $25. Maybe it's $50. Maybe it's $100 if you're really stretching. You're trying to do the responsible thing. You're trying to invest for retirement. You're trying to build wealth the slow way. You're trying to be the person you told yourself you'd become. And yet the numbers don't feel like progress. It feels like you're always a step behind. Every time you buy, something drops. Every time you wait, something runs. You start thinking, what's the point? Or worse, maybe I need to take bigger risks to catch up. That thought right there, that's Mr. Market leaning in. Benjamin Graham's Mr. Market is not a chart. He's a character. He's the emotional salesman who knocks on your door every day with a new price and a new mood. Some days he's euphoric and he begs you to buy. Other days he's depressed and he begs you to sell. He's not your teacher. He's not your friend. He's your business partner with bipolar tendencies. And the only way to win is to stop letting him dictate your decisions. If you're investing with a low budget, your entire edge is not speed, not hype, not getting in early. Your edge is discipline, and discipline is built on structure. So let's talk about the first reason small budget investing quietly fails. The first reason is invisible friction, the kind you don't feel until it's already eaten months of progress. People love talking about returns. Almost nobody wants to talk about the things that quietly subtract from returns: fees, expense ratios, bid-ask spreads, subscription tools, frequent trading, taxes triggered by turnover, options contracts that decay, just one more swing trade, just one more hot pick. It all feels small. It all feels harmless. But when your contributions are small, friction is brutal. If you're adding $50 a week, you're adding about $2,600 a year. Now imagine you're paying higher expense ratios than you need to, or you're bouncing in and out of positions, or you're buying products designed to be traded, not held. The market doesn't have to beat you. You can beat yourself with 1,000 tiny cuts. Graham's philosophy is often summarized as buy cheap, buy safe. But in practice, for a defensive investor, it's also keep it simple, keep it low cost, keep it repeatable. You don't get extra credit for complexity. Complexity usually means more moving parts, and more moving parts mean more friction. This is why low-cost index funds and broad market ETFs became such powerful tools for everyday investors. Not because they're magical, but because they reduce friction. A low expense ratio is not a sexy topic, but it's one of the purest forms of margin of safety you can buy. It's a guarantee that you're not donating a slice of your compounding to someone else year after year. And it's not just expense ratios. It's behavior packaged as strategy. If you check your account every day, you'll trade more. If you trade more, you'll pay more. Sometimes in obvious costs, often in hidden ones: spread, slippage, taxes, bad timing, and the worst cost of all, the cost of training your brain to crave action. Graham would tell you that investing is most intelligent when it's most businesslike. A business owner doesn't buy and sell their own factory because the mood on social media shifted. They look at cash flows, balance sheets, stability, and price relative to value. If you're building a portfolio, treat it like ownership, not entertainment. So the fix here is not dramatic. It's almost boring. And that's the point. Design your plan for low friction, automate contributions, prefer low-cost, diversified vehicles for your core, limit the number of decisions you have to make, and stop paying for adrenaline. And if you're going to pick individual stocks, do it the Graham way. Fewer decisions, higher standards, more patience, more margin of safety. Now, the second reason your low-budget strategy isn't working is one people hate, because it doesn't feel like investing at all. You don't have a defensive base, and without a defensive base, real life will force you to sell at the worst possible time. This is where middle-class investing gets real. You can build the perfect portfolio on paper and still fail, because the portfolio isn't connected to your life. Your car breaks down, your rent goes up, the fridge dies, a medical bill shows up, a layoff hits, your hours get cut, the credit card balance rises. Suddenly, your investing plan isn't competing against the S&P 500, it's competing against your need for liquidity. And that's not a moral failure, it's math. If you don't have an emergency fund, real cash, not I can sell my stocks if I need it, then your portfolio is not a long-term portfolio. It's a temporary parking lot. And temporary portfolios get liquidated at the exact moment Mr. Market is at his most depressed. This is why Graham's defensive investor approach matters so much for regular people. Not because it promises you'll never see losses, but because it tries to make your strategy survivable. Survival is underrated in personal finance. The algorithm wants drama. Graham wanted durability. A true defensive base looks like this. You have enough cash or cash-like reserves, high-yield savings, T-bills, a money market fund to handle predictable chaos, and you're not carrying high-interest debt that turns every small emergency into a crisis. Let me say it cleanly. If you're investing while carrying credit card debt at 20% plus, you're not in an investing problem. You're in a risk problem. You're paying a guaranteed negative return and then asking the stock market to bail you out. That's not a plan. That's a prayer. A low-budget investor who builds a cash buffer and reduces expensive debt creates a margin of safety outside the portfolio. And that margin of safety is what keeps you from panic selling when the market drops, when headlines scream recession, when the Fed surprises, when inflation spikes, when volatility hits. People think cash is dead because cash isn't exciting. But cash is not dead when it protects your long-term compounding. Cash is what gives you the ability to say to Mr. Market, no thanks, I don't need to sell today. And if you're thinking, but cash lowers my returns, remember Graham's priorities. Don't reach for return at the cost of survival. A portfolio that can't be held through a downturn is a portfolio that can't compound. Now we get to the third reason, and this is where the modern market really messes with small accounts. You're confusing conviction with concentration, and you're doing it in story stock. When you invest with a small budget, you can feel this pressure like you need a miracle, like slow and steady won't get you there, like the only way to catch up is to find the next NVIDIA early, the next Tesla early, the next AI revolution winner, the next crypto breakout, the next meme stock wave, the next options trade that turns $500 into $5,000. And listen, I'm not here to insult anyone. That temptation is human. It's also exactly how small portfolios die. Graham drew a hard line between investment and speculation. Speculation isn't automatically evil, but it's dangerous when it's disguised as investing, especially when your safety net is thin. A story stock is a company where the narrative is doing more work than the numbers. It might be real innovation, it might be real potential, but the price you're paying already assumes a perfect future. And when you pay for a perfect future, you leave yourself no margin of safety. Margin of safety is not a motivational slogan. It's engineering. It's building a bridge strong enough that it doesn't collapse when the wind changes. In investing, the wind always changes. When people with small accounts load up on one or two exciting names, they tell themselves it's conviction. But what it often is in practice is impatience wearing a suit. Conviction is earned through analysis and discipline. Concentration is often just a bet. Graham's checklist mindset is your antidote here. Financial strength, reasonable debt, earnings stability, a history of dividends, or at least a history of real profitability. Sound valuation relative to tangible fundamentals, not perfection, just enough quality that you're not depending on a heroic future. Now, for most people, especially if you're working full-time and investing on the side, the truest Graham-style approach is to be a defensive investor with your core, diversified, low-cost, broadly allocated, designed for long-term holding. If you want to do enterprising stock picking, keep it contained. Treat it as a separate discipline and don't let it hijack your retirement plan, because what happens in the real world is predictable. The exciting stock drops 30%, then 50%. Then you tell yourself you'll hold until you need money, or until the emotional pressure becomes unbearable, and then you sell low, swear off investing, and miss the recovery. Mr. Market doesn't beat you by being smarter. He beats you by being louder, especially when you're tired. So the fix is, again, boring but powerful. Build your core around diversification and low friction. And if you pick stocks, only do it where you can demand a margin of safety and where you can actually follow a checklist like a business analyst, not like a sports bettor. Now, we reach the fourth reason, and this is the one most low-budget investors don't even realize is the real killer. Your portfolio has no shock absorbers. In other words, your asset allocation is built like a sports car with bald tires, fast when the road is perfect, deadly when it rains. A lot of investing advice online is secretly 100% equity advice, or even worse, it's 100% equity in the most volatile corner of the market, because it backtests well in a bull run and it looks brilliant in a screenshot. Graham would hate that, not because he hated stocks. He loved stocks at the right price, with the right margin of safety. But he insisted on balancing common stocks with high-grade bonds for the defensive investor, precisely because markets are not polite. Markets crash. Markets overreact. Markets become manic. Markets become fearful. And the average person has a life that does not pause for bear markets. Bonds and cash are not there to make you rich. They're there to keep you from doing something stupid when stocks are on sale. Let's be honest about what kills small budget strategies during crashes. It's not the paper loss. It's the forced sale. It's the moment you need money, or you lose your nerve and you liquidate at the bottom. A defensive allocation, some mix of stocks, bonds, and cash, creates two forms of protection. First, it reduces volatility so you can stay invested. Second, it gives you something to rebalance from. When stocks drop, you rebalance by shifting from the steadier bucket into the cheaper bucket. That's not market timing. That's discipline. Rebalancing is one of the most underappreciated Graham-adjacent behaviors for regular people. It is literally the act of buying lower and trimming higher without pretending you can predict the future. And in a world where the Fed can raise rates quickly, where inflation can change the math on bonds, where markets can whip around on headlines, a structured allocation is not old-fashioned, it's adult. Now, I'm not going to pretend there's one perfect allocation for everyone, but the principle is universal. If your plan requires you to be emotionally unbreakable, it's a fragile plan. Your allocation should be designed around your ability to stick with it. For some people, that means a higher bond allocation. For some, it means holding more cash. For some, it means using a target date fund inside a 401k because it automates a lot of the behavior. The details can vary. The principle doesn't build shock absorbers so you don't crash when the road gets ugly. And here's the twist that changes how you see low budget forever. Low budget is not your disadvantage. Low budget is your advantage. If you stop trying to use it like a casino chip, if your contributions are small and consistent, volatility becomes less terrifying because you're buying through it. You're dollar cost averaging into fear and into euphoria. You're not trying to nail the top. You're building ownership over time, but you only get that advantage if your structure keeps you in the game. Which brings us to the fifth reason your strategy feels like it isn't working. You're measuring the wrong thing. And because you're measuring the wrong thing, you keep changing the plan. This is the quiet poison, the constant comparison. You compare your steady contributions to someone's viral screenshot. You compare your diversified ETF portfolio to a single stock that had a great quarter. You compare your slow compounding to a friend who got lucky with crypto. You compare your retirement plan to the loudest headline this week, and then you conclude, my plan isn't working. Graham would say, the market's job is to quote prices. Your job is to decide what those prices mean and whether they give you value. Price is what you pay. Value is what you get. When you measure yourself by price movements, you turn investing into a mood swing. When you measure yourself by process, you turn investing into a discipline. A low-budget investor should be obsessed with process metrics more than outcome metrics, especially in the early years, because early years are mathematically unimpressive. Not a bug. That's compounding. If you're investing $50 a week, your biggest lever isn't finding the next hot stock. Your biggest lever is consistency, time, and not self-sabotaging with friction. So what should you measure instead? Measure whether you're actually contributing regularly. Measure whether you're keeping fees and expense ratios low. Measure whether you're avoiding unnecessary turnover that triggers taxes. Measure whether your allocation matches your real risk tolerance. Measure whether you rebalance with a simple rule instead of with emotion. Measure whether your investing decisions are based on fundamentals and margin of safety, or based on stories and dopamine. Because here's the truth that sounds almost too calm for the internet. You don't need to predict the next recession. You don't need to front-run the Fed. You don't need to guess whether inflation is transitory or sticky. You don't need to know what the market will do next month. You need a plan you can hold when the market tries to scare you out of it. That is the entire game for the defensive investor. Now, let's bring all 5 reasons together into something you can actually use. Picture Mr. Market again, standing at your door with a clipboard. Some days, he shows up euphoric, telling you, this is the breakout. This is the AI wave. This is the stock everyone is talking about. Don't miss it. Other days, he shows up trembling, telling you, it's over, recession is here, sell before it goes to zero. And you, if you're going to invest like Graham taught, you do not argue with him. You do not try to change his mood. You do not try to impress him. You simply decide whether his price is attractive relative to value and whether your plan still makes sense. So here's a simple audit you can run on your own strategy right now. Without any fancy tools, ask yourself, do I have a real defensive base, cash reserves, and a plan for high interest debt, so I won't be forced to sell when life happens? Am I minimizing friction, low fees, low expense ratios, minimal unnecessary trading, so compounding can actually work? Is my core portfolio built for a defensive investor? Diversified, business-like, not dependent on one story stock or one hot theme? Do I have shock absorbers, bonds and cash, or equivalent stability so volatility doesn't turn into panic? Do I rebalance with a simple rule so I'm not letting emotions steer the wheel? And finally, am I measuring success by process and long-term ownership, or by whether I beat the market this month? If you can honestly say yes to most of that, then your low-budget strategy isn't failing. It's maturing. It's becoming the kind of plan that survives. And if you can't say yes yet, that's not a reason to quit. That's your roadmap. Because the real tragedy in personal finance isn't that someone starts with too little. The tragedy is when someone gets discouraged by the slow early phase, and then hands their future over to Mr. Market's mood swings. Let's close the loop with that Friday night scene. It's the same person, same job, same tired feeling at the end of the week, same transfer, $50. The headlines are still loud. AI stocks are still being hyped somewhere. Options traders are still posting screenshots. Crypto is still doing crypto things. People are still arguing about rates and inflation and the next crash. But something is different. This time, the person doesn't need the market to entertain them. They don't need a miracle. They're not scanning for a lottery ticket disguised as a stock tip. They have a defensive base, so life can punch, and they won't liquidate the future to pay for the present. They have a low-friction core, so compounding isn't being siphoned away. They have an allocation with shock absorbers, so volatility is uncomfortable but not catastrophic. They rebalance with a rule, so downturns become a disciplined response instead of a personal crisis. And when Mr. Market shows up, euphoric or depressed, they don't obey him. They use him. That's what Graham meant when he tried to teach ordinary people how to survive Wall Street. Not to outsmart it in the short run, but to outlast it in the long run. Low-budget investing works, but only when it stops trying to be exciting. It works when it's built like a bridge, not like a bet. And if you remember nothing else from this video, remember this. Your first goal is not to get rich fast. Your first goal is to not get broken. Because once you stop getting broken, time starts working for you. Compounding starts working for you. And the market, no matter how loud it gets, stops being your master and becomes what it always was meant to be. A place where patient ownership quietly beats noisy prediction. If you want, in the next video, we can take this one step further and build a true Graham-style defensive portfolio map. How to think about bonds versus common stocks, how to set a rebalancing band, and how to use a simple quality screen so your stock picks, if you make any, are anchored in financial strength instead of hype.